you for joining in today. It's KK from TK. Really appreciate all the views that I've been getting. Hopefully I'll be able to provide you with some information moving forward. And this particular topic we're going to be talking about today is about permanent insurance. So sometimes people refer to permanent insurance as PAR or permanent insurance or whole life insurance. This sort of insurance lasts forever. So I'm going to start off with telling you a story about my dad. He recently passed away on March 31st. It was heartbreaking to me. He was 89 years old. Very nice man. Never raised a hand on me, never yelled at me. Tremendously upstanding citizen of this country. He was always considered somebody who would come in and make friends with everyone. Tremendously nice guy. You know, about several years ago, I'd asked my dad, and we were looking into his finances and seeing what he had and stuff. And he pulls out this insurance policy. And I looked at the insurance policy. It wasn't a large amount. It was about probably $110,000 at that time. But he was paying quite a bit for it. And I looked at it and I go, Dad, I think you're paying quite a bit for this. He goes to me, he goes, you know what? It doesn't matter. I want to leave this money for your mom. I don't want to leave her stranded at the end because you never know what could happen. And I said, okay. I never brought up the subject again. And I understood what he's talking about at this point. So when he did pass away, I was thinking in my mind, because I'd forgotten about this life insurance policy he had. And this one was a permanent policy. I said, how's my mom going to live in this house? Because now all of a sudden he passed away. There's no more income coming in. There's no more CPP. There's no more OAS. No more government supports. They've all been cut out. So I thought, how is this possible? And then I was reminded, that's right, Dad had a policy. So this is the policy I talked about in the other video too as well. We got in touch with the insurance agent, and 2 weeks later we had a check in our hand. I deposited that into my mom's savings account. And I thought, you know what, Mom, you don't have to worry about anything. You don't have to worry about moving. If you want to stay, stay. If you want to move somewhere, move into a smaller place. But really, you don't have to really worry about anything at this point. So I want to talk about permanent insurance because I think this is where we should pay attention to this, because one, it's a very complicated product too as well. And this can provide safety for a lot of people. You don't realize how much safety it can provide when you're not around. So there are 3 types of permanent insurance, and one of the ones is actually a term insurance. It is a permanent insurance, and it's called term to 100. And the other one is called whole life, and sometimes that's also called PAR, participating insurance. And the other one is called universal life. So I'm going to go through a little chart over here. I'm not going to bring myself up into this chart, so I'll just show it to you. So basically, when you're buying life insurance on a permanent basis, so you have payments, you have to pay the insurance company, and what you get from there is insurance coverage. So this one is about term 100, so there's only insurance coverage. So if you buy $500,000 worth of coverage today, 40 years from now, it's also going to be worth $500,000. So that's your total coverage. Now you have to think about this: is $500,000 today going to be worth the same $500,000 40 years from now? I'll give you an example, and this is what brings it up to me in the past. Anyways, I remember going to McDonald's, and we used to pay 49 cents for a Big Mac. And that kind of ages me, but that's okay, because you go in right now, I don't know what it is, it's like $3.99, $4, $5, I don't even know. I haven't been to McDonald's such a long time. But imagine that 50 cents you would think would be worth a lot back then. And if you bring that same 50 cents today, I can barely buy fries. I can't even buy fries with it, let alone a drink. So that's what you have to be aware of when you're looking at term to 100. So let's look at whole life. So when you make your payments, it basically goes into 2 different parts. One goes into that life insurance coverage, which is kind of a T100. And then the insurance company also invests part of that money. Now this money is also called cash value. You've heard of this before. And that cash value also will purchase more insurance. So when you buy $500,000 today, it's not worth $500,000 in 40 years. It could be worth $2-3 million. So what this takes care of inflation. So inflation doesn't degrade the amount of value of that dollar amount. So when you make your payments, some of it goes to life insurance, some of it goes to the investments the company does for you, and then that gives you your total coverage. Now there is one more, and that's the universal life. So universal life kind of has a couple of little nuances to it. So you do the same sort of payments, it goes towards life insurance, but in this case, instead of the company choosing what to invest it in, now you're going to choose the investments. So that will also provide cash value for you, and that gives you a total coverage. But sometimes this doesn't hedge inflation. And I'll tell you why. Because with universal life, that part of that investment, it doesn't buy more term insurance for you. So sometimes it's better off going on with whole life than it is with universal. But like I said, every case is going to be different for every scenario. So what are the advantages and disadvantages of owning a whole life policy? So let's go into the advantages first. And so the advantages are you're going to grow your wealth. That's for sure, because the dollar value doesn't stay the same, it always increases. It's a tax advantage too as well, because everything that you put into it, every growth that happens within that policy, you're not going to get taxed on. So it'll be like a tax-free savings account in there. Then you can also take a loan on it too as well. So let's say you're in urgent need for some money and you don't have it anywhere else. Well, guess what? Your life insurance policy can be part of it. You can take a loan on that. Now that also, your life insurance policy also has a cash value. So there's a guaranteed cash value. So let's say you decide 20, 30 years from now, you know what? I don't need life insurance. I just want to cancel it. You'll actually get some of your money back. Which is not too bad, because when you look at term, you're not going to get anything back. The other thing about permanent insurance is that you're going to plan for your legacy too as well. So let's say you wanted to leave your kids or your church or whatever else, your charity, some money behind, you're able to do that, and you're able to plan it out, because remember, with permanent insurance, it's 100% payable. And sometimes what we do is with small, medium-sized businesses, we also plan taxes in the end. So let's say they have a tax liability of $500,000. We can plan for that tax liability through permanent insurance. Now, one thing about permanent insurance you got to remember is that you're going to get 100% paid out. Unfortunately, this is a morbid topic. Everyone's going to die one day. But this insurance will pay out 100% in the end, while with term, it's actually less than 3%. So the other thing people look at for advantages on permanent insurance is last expenses. So who's going to pay for the funeral? Who's going to pay for that dinner or party that you're going to have? Then the last thing is that it's also going to bypass probate. So there's no taxes on this, 100% tax-free, and it's private. So let's say you bought life insurance and you wanted to go to a child that nobody knows about. You know what? It can go there, and nobody would ever know that actually went there, because it's not made public. The only way they would know is that if that person actually made it available public. So there are disadvantages. It's obviously a disadvantage to everything. One, it does cost a lot. It costs more than term insurance. It's very complicated, hard to understand, because there's so many moving parts on permanent insurance. And you always get people saying, oh, it's mediocre. I can earn 10% somewhere else, and this one's only like 5%, 6%. Yeah, but you got to remember, the volatility on this is very, very low. So when you look at that over a long-term period, I don't think mediocre investment returns is applicable in this case, but people do say that though. So let's talk about the fine print. So fine print is not all permanent insurances are the same, okay? So whenever you're looking for permanent insurance, make sure that you run comparisons at least 3 companies. They all pay different dividend rates, and they all grow different. I've had comparisons done with one company where they're paying 6.5 dividend rate, and the other company is paying 5%. And actually, the 5% turned out to be better than the 6.5% in the end. And the only way you can learn this is by running those comparisons. You can't learn on by what somebody's telling you. Oh, this is earning 6.5, this is earning 5. It's kind of a strange scenario. And the other part is with universal life. So you have to stick to the funds some of these companies provide, and those funds, they're charging high management expense ratio, which is called the MER. So, and there are some that don't charge a lot at all. So you have to decide on which company to go with or what they're charging and how that's going to affect your policy and how it's growing. So with whole life and participating, they have a certain investment mixture. Usually it's about 75 in income and 25% in equity. Insurance companies are not into taking risks with anything like this. So what they do is they minimize their risk. They try to, make everything smooth as you go along. And you're the number one that gets paid. So those dividends that get paid out, it doesn't get paid to the shareholder first. It always gets paid to you, the owner of that life insurance policy. And then about the MER within there. So the management expense ratio within that life insurance policy, within the whole life participating policy, is very, very low. It's like in some companies it's as low as 0.08%. You're never going to get that anywhere. You can't get that in an ETF. You can't get that anywhere. But the most important thing about a whole life policy, and this is to be paid attention to, is that make sure you don't go with a small company. Because a small company, there's more risk involved in there. Because what you're basically doing with a whole life policy, you're participating in their profits. Well, if they have a bad year, you're in trouble. So if it's a large company, here and there they can do bad things, but overall it's really not going to affect much. So I hope you like that, and I hope you understood a little bit more about whole life, universal, and even term to 100. If you have any questions at all, please let me know. You can always email me. I've put my email at the bottom of the video too as well. Please follow me. Please share this video so everyone else can have an understanding of this. And we'll see you next time. It's KK from TK Financial Group. Take care.